All right, everyone. So, welcome to the Note Investor podcast. Joined here today with Jason Bible from Right Path Real Estate. So, Jason, how you doing?
I'm doing good.
Good. Well, man, thanks for coming on. I really appreciate it. Um, you're a little bit different than some of the other note investors that I've had on. I know you've got a pretty large operation down in Houston. So, why don't you tell us a little bit
Mhm.
about, you and Right Path Real Estate, what you're all about?
Well, it's funny you mentioned RightPath. I sold that company about a year ago. I sold that company, Houston House Buyers, and another company called Quality Property Solutions. And the reason we did it was, and this was probably right around the time I was at the mastermind with a Scott's mastermind where I met you.
Yeah, because I think we met up, was that last August or September? It was around the time of the Quest Expo last year, I believe.
Yeah.
Yeah.
So we were, that was the last event I actually spoke for RightPath, but I can give you that whole story. I looked at, we were fixing and flipping and wholesaling like 100 houses a year, and it was great, and we made great money. But the reality is, you just don't build any real wealth doing that. And so my business partner and I at the time had a difference of opinion on what we should do moving forward. So I sold those companies in September, and since then we've bought. We're principally focused on small apartments and Airbnb. So we've bought, I actually just closed one this morning. We're right at 50 Airbnb doors, and we're at 100 something small apartments. So it's, yeah, that's what we've been doing for the last year, really doing a lot more buy and hold than the fix
Uh,
and flip business.
right. Yeah, because I guess, I mean, I've never done fix and flips, but I guess that just tends to be more transactional as opposed to something you can collect cash flow on.
Yeah, absolutely.
Uh,
And, it's not really real estate investing. It's more, you're running a construction company. That's really what it comes down to. Um, Now you're finding great deals and all that sort of thing. But if you're not keeping these things, you're really not doing any real investing. You're just, flipping to the next thing, to the next thing, next thing, and you're always looking after the next deal. This year I spent 2 weeks in Utah with the family doing hiking and all that other stuff. And
yeah,
I don't think I could have done that last year, just with the way our business was running, our real estate education company, all that stuff. It just wasn't something we could do. And what I think a lot of people miss about real estate investing is it's not necessarily the let's build a lot of wealth and retire. It's the fact that you can start and stop at any time. So if you're buying notes, if you're buying single family houses and Airbnb and small apartments, those sorts of things, you can take a month or so off. You could take 2 or 3 weeks off, and and it's not that big a deal. Whereas you can't really do that, with your normal job. And if you're a
right,
wholesaler or flipper, you really can't do it. You really can't do that either. So you can continue to build your portfolio, while on the road. But if you don't want to, you don't have to. So you
right.
get a little burned out, you can take some time off. Like, it's not that big a deal. So that's really hard to do when you're running a real estate, business. And really, it's a small business inside of real estate. So
Hmm.
that's that's the real challenge there. So, but yeah, that's what we've done last year. And like I said, we're focusing on Airbnb and small apartments.
Uh-huh. And then you do some, I know you've got a podcast and radio show
Hmm.
and some, real estate education and whatnot as well, right? A lot of other things going on.
Yeah, so we have a daily radio show here in Houston, and all the things that we do is really predicated on deals and money, bringing in deals, bringing in money, and doing more deals. And so we started a new radio show April 1st this year, and it's one of the fastest growing shows here in Houston. We're now moving it over to a larger radio station, and they're giving us an extra hour. So we'll have a 2 hour daily radio show in the evening times called Real Estate After Dark. That's what we're gonna rename the show After Dark. And we just signed up New Jersey. So on Saturday mornings, actually no, Saturday afternoons, if you're in New Jersey, you guys will hear the show up there on 1500 WONT. And we're working on syndicating the show in Southern California. So The
Nice.
idea is for us that we're going into markets where we know that the real estate is kind of overheated, if you will. It's in a it's so funny. Last time I was at Carn Hall's event in Orange County, the Orange County RIA.
Hmm.
She asked everybody. She said, "Who here invests in Orange County?" And I didn't know it was like a joke, right? Like everybody, like, ha ha ha. Nobody invests in Orange County, and they live there,
Yeah.
right? So even the mom and pop investors in Southern California recognize that the Southern California market is just overextended, and we're starting to see that in parts of Jersey. Obviously, New York has had a heck of a time since the SALT provisions were passed under Trump's tax plan,
Hmm.
especially in the luxury market. So we're in any case, we're going to these markets and taking the Mr. Texas Real Estate, that's our Keller Williams team, the Mr. Texas Real Estate team into these markets to say, hey guys, come down and invest with us in Texas. Like, we'll sell you some houses, you can be a part of our mastermind, you can do, all this cool stuff with a partner down here in Texas. And it's a fascinating, when you talk to any of these people, any of these investors in these other markets, they're like, oh yeah, they're investing in Dallas, San Antonio. Some obviously are investing in Phoenix, but Dallas, San Antonio, Houston. It's amazing to me how many investors I run into out of state at these meetups at these more expensive markets that are already here investing anyway. So that's what we do.
Yeah, I mean, as I said, like, those real estate markets are so tough, and I know like a lot of my joint venture partners come from those states, and like I've talked to people from California before who don't even realize that there are houses that cost less than $100,000.
Yeah, yeah, no kidding.
Is that actually a real thing? Like, what is that? Is that a shed, or how does that work? No, it's probably the vast majority of the housing actually in the country, at least on a numbers basis.
Oh yeah, absolutely. Yeah, when you get outside the major metros, I mean, it is shocking to me though how fast houses are appreciating, and I've been on the speaking circuit for the last couple of months. Everybody's waiting for the next crash, and what I keep telling folks, I'm like, there's a housing crisis coming, but it's not the one you think it is. The next housing crisis is affordable housing, a massive shortage in affordable housing, because we just can't build that stuff that cheap anymore. We can't build houses under $200,000 in mass. I mean, certainly you can, you can build a couple here or there, but
Right.
the reality is that you can't build them that cheap anymore. So I keep telling folks they're waiting for 2008 all over again, 2007. I'm like, guys, it's not happening. It's just not. We're not
Yeah.
overhoused. We're not building a bunch of houses. It's not easy for people to get loans, but they believe that because real estate's become more expensive, there's a crash imminent. And I'm like, there's not. There's a huge housing crisis coming.
That's a
And
question I get a lot. People ask me, like, when's the recession coming? Where does all this lead? We've been running hard for 10 years or so now. And yeah, so how does that impact the, especially like the lower end of the market in some of these areas that are outside the major metro areas?
I think a lot of that, I mean, there's definitely going to be a recession coming. I mean, there's no doubt. It's just a natural part of the business cycle. But people also, most folks equate recession with market downturn in real estate. And if you look at recessions in the past, you can pull this up, all this data is available from the St. Louis Fed. You could see median home prices. You can see the Case-Shiller index just continue to truck on upwards through those recessions, with exception to '07 and '08, because that was really a credit crisis and a housing crash, right? But you know, real estate downturns are typically every 20 years. They've got that goes back 150 years. That's pretty easy to track.
Hmm.
So as long as we're not, foolish with our capital and giving people houses that can't afford them, I don't think there's going to be much of a downturn. Now, back to your question, what happens in these other submarkets? Well, it really depends on what's going on in that submarket. Real estate's local, right? I mean, at the
Yeah.
end of the day. So Texas, and in particular Houston, are counter-cyclical, especially Houston. So as the economy turns into a recession, usually that means Houston's booming. So if you look at the median home price in Houston compared to Dallas-Fort Worth, at least the rate of change, the increase in value, Dallas is much more robust. It's much more a faster appreciating market as opposed to Houston. But
Mhm.
when the economy starts to slow down, that will absolutely have a huge impact on Dallas, but not necessarily on Houston. So when you start looking at these other submarkets, what's going on in Florida, what's going on in Michigan, or what's going on in Ohio. I mean, it really depends on what's happening in that submarket. That's what really predicates what's predicated on the housing market. And there's two things at play there. One is population, and the second one is jobs. So, the old adage is for every two jobs created, one house is bought.
Yeah.
That's kind of the old school thing there. And do you have people moving to your state? I mean, there's a lot of people moving out of New York, out of California, and they're moving to places like Florida and Texas. I read a stat the other day that said in Harris County alone, it's like every day a 747 flies into Harris County, drops everyone off, and flies back empty. I mean, that's just how
Yeah.
many people are coming to Texas. Um, the Texaplex plan, which is just an idea of really it's a well studied document. If you go to the texaplex.org or something like that, but you type in
Uh-huh.
Texaplex plan, uh, we're going to have 18 million people here in the next 15 years. So where are all these people going to go? Because we can't
Yeah.
build affordable housing anymore, under $200,000. And so what's going to be that impact? Well, we're going to have more renters, and we're just the price point below, let's say $300,000 is just going to get higher and higher. A median home price now is $250,000, which is
Yeah.
insane when you think about it. It's like 110 grand more than during the crisis. I mean, houses have doubled, and houses essentially at the median have doubled in the last 10 years. And I don't see that abating anytime soon. But yeah, back to your question. It's like it depends on what's going on in that submarket. What happens when a key employer leaves, or what happens when one moves in? I mean, look at house prices when Amazon announces they're going to set up shop, in one of these places, in one of these
Oh
markets, or
yeah.
Google or Apple. I mean, there's a huge run on real estate. So where the jobs are, there goes the housing.
Yeah, exactly. So then, for investors out there, I mean, where do you see them putting their money versus, real estate versus their 401ks and other types of things, like knowing that a recession is coming? I know for me, when I started getting into notes, part of it was I wanted to move money out of stocks because I was worried about having just so much of my net worth
Mm-hmm.
wrapped up, into real estate. Whereas I know, like most people traditionally, that's what they do. They just plow, all their money into their 401k, and that's pretty much where it stays. I mean, where do you see like a good mix of the two?
Here's how we do it at my house. I can't tell you what the best asset allocation is, but and there's a ton of models out there that can show you what's the best allocation for assets. Although, given that rates are so low, a lot of those models start to break down at the zero bound layer. So when you start talking about 0% interest rates and risk-free rates of return that are like negative, any of those mathematical models just don't work anymore. So here's the way I look at it. In our household, if your employer has a match, then you meet up to the match. You go to if you got a 7% match or 3% match, whatever, then you put that into the match. And for us, I'm a big fan of, Vanguard's got a handful of little S&P 500 ETFs, right? Just buy the index and move on. And then the rest of our net worth, we got some in cash, but the vast majority of it's in real estate. And the way we diversify, if you will, in real estate is we've got some long-term single-family rentals, we have some Airbnb properties, and we have some small apartment complexes. So actually, we have a hotel under contract. We're now getting into the hospitality business. So
Oh, nice.
we're doing all kinds of stuff. Now we're just having fun with it. But that's kind of the allocation I look at. Here's I think the end goal for a lot of people. They just want cash flow, right? I mean, yeah, you could have $5-10 million bucks, but at the end of the day, that's every dollar that's not put towards a productive asset that dollar's worth less every single day. So for us, I look at cash very differently than a lot of real estate folks, or investors in general. Like, oh, I got to have this cash set aside. I'm like, that cash needs to get put to work.
Yeah.
And here's why. that the most houses in, let's say, Texas, between 5 and 7 years will double in value again. Like there's no doubt about that. At the affordable house, I'm not talking about $1 million homes, I'm talking about, $150,000, $175,000 homes.
Mm-hmm.
They'll double in value again. And if you want to build, I don't want to call it risk-free, but lower risk cash flow, buy real estate that's paid off.
Mm-hmm.
So you could go and buy 20 rental properties and hold on to those for 5 to 7 years, sell 10 and pay the other 10 off. And you'll make about, at net, when it's all said and done, when those 10 houses are free and cleared, you'll make about $10,000 a month in cash flow. It's the numbers are pretty clear at this point. So my goal is, over the next 5 to 7 years, is to buy as much of the stuff as I can. Then at that, when we've owned them for that, let's say 3 to 7 year mark, take a look at the portfolio and say, what can we sell? What do we want to keep, more importantly? And then let's figure out what we can sell and pay those things off. So we did a deal, my biggest deal to date, which I'm going to knock on the apartment guys a little bit here. Everyone talks about getting into apartments because that's how you make millions of dollars. We made $800,000 buying 9 units. So we bought 4 single families, a duplex and triplex. And we sold a portion of that portfolio off, but we bought it at such a great discount that we're selling 3 of those single families off, and we'll essentially have 1 single family, a duplex, and a triplex free and clear. Easily $800,000 in value. And they're bringing in gross about $6,000 a month. So when you start looking at, I look at least my investment strategy in real estate is, can I get into asset classes that nobody else is in? So, all the apartment gurus out there tell you to don't buy anything below 60 units or don't buy anything below 100 units. I'm like, yeah, keep telling people that.
Yeah.
Because we're going to buy in duplexes that are cash flowing $1,000 a month, right? So I don't need a management team and a huge PPM and a big capital raise and, $10,000 appraisals and all that. And then the deal falls apart at the 11th hour, right? I can go down the street, buy 5 duplexes, raise private money to do it, and make $5,000 a month off them. So I think there's easier ways to invest, but that's kind of the way that we look at the world. We look at it from can we put cash into assets? Can we turn financial assets into real assets? And then when and how fast can we deleverage those real assets?
Mm-hmm. Yeah, I have a friend who does, has done kind of a similar model that he started back in the 80s.
Mm-hmm.
At his peak, he had some insane number of rental houses here in the Denver area, and then kind of slowly paid them off over time. And now he's kind of semi-retired, sold a bunch of them down, and just lives off a bunch of cash flow from his good ones. So it's a nice strategy over the long term. Yeah.
It absolutely works. There's a guy here in town. I already guess he's probably got close to 1,000 houses, and he started even earlier than your friend. I mean, like in the 60s and 70s. The guy's like 90, he's 92, 93. Mm-hmm. And they are all free and clear. And I mean, he's making it. And of course, the challenge is, and your friend probably has this issue, in Denver, the appreciation's just been absolutely insane. So, he's renting these things out for $1,500 a month, but they're $340,000 houses, right? But he bought them so long ago, they were $40,000 houses. So it's, I'll tell you that strategy, it absolutely works. It really does on the long term. And I see, probably the most depressing thing I see is when I run into other real estate investors and they tell me like, we've got an event coming up next week. There'll be 1,000 investors there. It's a once a month event. It's one of the biggest in the country. It's a great event. We're sponsors of it. Our Mr. Texas Real Estate team is. And what's amazing to me is when you talk to these investors that have been in the business for 20 years, I'm like, why aren't you filthy, stinking rich? Like, you've been in the business 20 years. And what they end up doing is they go from notes to flipping houses to wholesaling deals, going back to flip to an owner finance. And there's a real value in focusing in on one asset class, right? Or one strategy, because you get really good at it and you start to build that portfolio out, which is what your colleague did there in Denver. And he's doing okay, you know?
He's
So,
doing outstanding. Yeah, he's got his place down in Arizona and plays golf at nice places, and it's yeah,
mhm.
a good deal. Yeah, it's like the get rich slow plan as opposed to the as you were saying, getting into the whole shiny object syndrome
Mhm.
that everybody's prone to, and I'm prone to as well to some degree. So
Oh yeah, I mean everybody's human, right? I mean I get it. Like but if you can limit that to the least amount possible in your life, it's kind of like, I love eating steak, but I can't eat steak every day. I mean, I just, it's probably not good for you.
right.
I like craft beer, but you can't drink beer all day. Like it's just not,
No, that's a
not
bad thing.
healthy.
That's not going to help your investing. Yeah, it's not gonna,
No, it's not going to help investing at all, right? So, there are a lot of things that, just taking in small doses, if you will, in moderation. But and then limiting all those things in your life that cause some of those distractions, and just stay focused on it. And I'll tell you, I see it every time. I go to a lot of networking events, I speak at a lot of events, and everyone's trying to reinvent the wheel. Like, oh, we're going to do this and we're going to do that. It's going to be this land trust. We're going to flip it around, turn it on its head. I mean, all this ridiculous stuff. And it's like, just go buy a rental property, dude, or just go buy a note. I mean, just keep doing that.
yeah.
You do it long enough, you get rich.
Well, and what's nice too is when you do the same thing for a while, you get your processes down. It's
Yeah.
like with me with notes, like buying the first one took me a bunch of time, and a bunch of agony, and then I got that done. But after you do 50 or 60 of them, it's a heck of a lot easier now. It becomes one of the things I like about real estate in general versus some of the engineering I used to do is it can be a very rinse and repeat business. Once you get a template down for how to
Mhm.
do something, you can reuse it again and again and again. It's kind of
Yeah.
nice.
Well, and here's the other challenge. If your focus is all over the place, you never develop a mastery. Never become proficient in, oh, that's a deal, that's not a deal. Let's do this one. The deal I talked about a minute ago, where we made $800,000 on, it broke out of escrow twice before it came to us. And when you look at this deal, we literally bought like an L-shaped corner. Like we almost bought a block. I mean, that's how much real estate was there. And the houses are all torn up, the streets torn up, the sidewalk looks awful. I mean, when you pull up, you go, "Ooh, this is bad."
Yeah.
But when we looked at that deal, we were like, we can totally do this because we've got the experience, because we did, between Rob and I both now over 1,000 flips in Houston and Jersey and Southern California. So when he and I pull up, it's like we pulled up to the street there. We're like, this is no big deal. Pour some concrete, fix a curb, talk to the city. I mean, it wasn't that big a deal. And you don't develop that proficiency unless you're doing a whole lot of stuff. And I'm sure it's the same thing in the note business, where you could sift through these things so fast now. And you're like, nope, nope, nope. Oh, this one looks interesting. Let's pull this in.
Yep.
Where that one you pull in to look at, 100 other investors passed on because they don't have the level of expertise that you've got. I think people really, really discount. I see this in real estate all the time. They discount experience. When they go from thing to thing to thing, or they go to the seminar that tells them they can get rich quick in 5 days or less, it's like, man, you're greatly discounting the experience. One of my favorite quotes is, and I'm going to screw this up, but people overestimate what they can do in a year, but they underestimate what they can do in 5 years. And a lot, you get the New Year's resolution crowd, right? And it's, okay, we're going to do this, and by the end of this year, I'm going to lose all this weight. I'm going to be, bazillionaire. I'm like, well, let's look at things on a 5-year timeline, because 5 years you could do some really cool stuff, but in a year, not so much.
Right. Yeah, I think that might have been like a Bill Gates quote, or I think I heard him like re-quote that. But
Yeah.
But yeah, definitely staying away from the New Year's resolution stuff is always good. I remember when I lived in Florida, there was a gym I went to, and if you tried to go there in January, it was just a nightmare. But by February, everybody was gone, and it was like a ghost town. It was kind of nice.
Yeah, by Valentine's Day, everyone's gone.
Yeah, absolutely. So, and then let's talk a little bit more about, you mentioned doing Airbnbs.
Mm-hmm.
It's something I haven't looked at myself, but I'm curious how, Airbnbs work compared to, more traditional rentals?
So I'll tell you there's some advantages and disadvantages. And I'll tell you the disadvantage to Airbnb is it's a lot more management intensive. Like that should be obvious, right? I mean, it's not like a
Yeah.
long-term tenant. It's not a long-term, kind of relationship, if you will. It's very lucrative. And I'll tell you it's lucrative in two scenarios. You either want a really big house with a bunch of rooms, have their own baths, like suites, or you want a really small house. Like
Mhm.
there's not really any in between. Like big house or small house, there's no in between.
So big house, are
So
you carving that up and renting
yes,
multiple rooms, or yeah?
right. So we're doing something called lock-offs. So if we've got a 6-bed, 6-bath, we're literally running it like a small hotel.
Okay.
So, and you would think like, well, who wants to, I mean, it's kind of weird, like a bunch of other people staying in a house. What ends up happening is it's typically business travelers. And it's like a team of, like we've got one down in Dickinson, which is right down the street from NASA. In fact, I closed another one in San Leon, which is right down the street, but is on the other side of NASA. And, it's like a team of engineers coming down for a, 3-month project.
Yeah.
And all the guys and gals all stay in the same house. I mean, that's really that's what it is. Uh, and so those can be pretty lucrative. Now, we also have places, vacation rentals that we've got on the beach, and we don't want the big houses on the beach because those turn into party houses.
Yeah, that seems like you could get into some damage and other problems. Yeah.
Yeah, your neighbors hate you. That's probably the biggest problem. The neighbors end up hating you. So for us, that's really kind of the Airbnb marketplace, if you will. And typically on the low end, you're making, let's say, $300 a month per door. So if you've got a 6-bed, $300 a month, I mean, you should be making about $1,800 a month net at the end of the day. And our houses, it really depends. We've got one in Texas City, which if any of your listeners know where Texas City is at, you're probably wondering, why do we have an Airbnb in Texas City? Because it's a lucrative place. There's not many Airbnbs there. There's a handful of hotels. There's a great business traveler base there. So at 1,000, I want to say at 50 to 65% occupancy, we're cash flowing $1,000 a month on a $120,000 house.
Nice.
So now, again, it's a lot more management intensive. So, our gross may be, I don't know, $1,800 to $2,200 a month. But once you figure in the cleaning and all that other stuff, it
Right.
rounds out to about $1,000 a month. Which brings me to my second point. One of the things that's really nice about Airbnb is that your properties are in much better condition, way better condition. Because we've got a maid that's going in there a couple of times a week. We've got a handyman that's there once a month fixing stuff. So that's a huge advantage over rental properties. Your CapEx is, maybe a better way to put it is, your deferred maintenance is a lot lower because it's built into all your Airbnb numbers.
Right.
Unlike most landlords, they really don't account for the operation and maintenance of a rental property, and they really don't account for CapEx either. Now they do when it comes to tax time. They call that depreciation. That's really where depreciation comes from, right? So anyways, your properties are in much better shape. And probably the third biggest advantage is we can pick when we want to sell. So instead of like this long-term rental, you get a tenant in there in January, and the tenant moves out, and you want to put the house on the market, and you're on the market in like February, right? I mean, not a great time to sell a house. But in the Airbnb space, you just wait till summertime, get everybody out. You can have showings. You can set up your Airbnb in such a way that you're doing showings like on Sundays, so you can't book on Sundays. So you could have an Airbnb.
Yeah.
Yeah, you could be doing Airbnb and then literally showing the house on Sundays to get it, to sell it. So a lot of cool different things that you can do with Airbnb that you can't do with other assets. Our office, I'm here. This is our office on Park Row. We're high atop the Quest Trust building. Quest is on the first floor. So this is kind of where our money office is. We just closed and refinanced a house in the Houston Heights, which is this little trendy area inside the Loop. And That particular house, we've converted 2 of the beds to Airbnb. So we're gonna have our office there, and then we've got Airbnb on the garage apartment in the master suite. So um,
Mhm.
our office space is gonna pay us, which is kind of nice.
That's very cool. There's a lot of creative
So,
stuff you can do with those.
oh yeah, it's fun. Like if I were flipping houses, I'd buy houses with garage apartments in them, and then I'd rent that garage apartment out while I'm finishing out the rest of the house for the flip to offset your capital costs for holding costs and taxes and insurance, all that kind of stuff. So
Right.
um, there's a lot of really cool stuff you can do in the Airbnb space, and I'll tell you, I think it's just in its infancy. I think that you are going to see Airbnb is going to become much more commonplace. It's been Airbnb, I want to say, is 15 years old, somewhere around there. So
Uh-huh.
it's only going to get bigger, and there's only going to be more people in the space. So we really like it. Like I said, the hardest part is the management side of it, and once you've got that figured out, then it's not as difficult as someone think it is.
And are you managing that like internally? Do you have people on your team that do that, or do you have like companies that you hire to that specialize in that to handle the?
So I'm a partner in an Airbnb management company, but we do not offer our services yet outside of our portfolio.
Uh-huh.
There's a couple of reasons why. Like I said, they are much more management intensive. We may do that in another year or two. We're still onboarding all our Airbnbs and our hotel and all that other stuff. So we're not really ready to open up shop for outside investors. But yeah, you've got to either manage it yourself or you got to find someone. And I will tell you, the national companies that manage your Airbnb from afar, I'm not sure if those are going to be the best value for a lot of folks. You really want someone local that has the cleaners and the handyman and all that sort of stuff. It's really hard to do from afar.
Yeah, I would imagine. Like I know in my business with REOs, like I've done some experiments with some of the national companies that will manage REOs for you, and it's
Hmm.
always been a nightmare.
Mm,
I really got to find my own people on the ground running
yeah,
everything, and then everything goes fine. It goes remarkably smooth. But
yeah,
yeah, I found dealing with a big national company when I've got maybe one or two assets just never seems to work out very well.
yeah. It just yeah. I don't want to say you kind of wanted you're just kind of a number, but it Airbnb, it's kind of interesting because it's obviously a tech play, right? So you've got to get up every morning, you got to play with the algorithm a little bit, we're really concerned with, well, what's our bottom line? Like, what's our net? And everybody gets concerned about occupancy with Airbnb, and I'm not so much concerned about occupancy as I am by what's my bottom line. So if you allow Airbnb to set your rates, you begin to run into issues where they're pushing occupancy, but it may not be the most profitable occupancy. So for me, at the end of the day, I don't care if my house is rented 1 day a month or 30 days a month. The number at the bottom is the only number that matters to me. So you've got to tweak and play with that a little bit, every day. And I think that's where a real property management company earns their stripes, if you will, really earns the gold star is, are they actively managing the pricing structure through Airbnb? Because their algorithm will push for really optimized for occupancy when it should be optimized for your bottom line.
Yeah, definitely. So cool. Well, hey, I think that's probably a good stopping point. So, hey, Jason, thank you so much for coming on. Really appreciate having you and like to have you back again at some point in the
You
future.
bet. Thanks, Dan.
All right. Thanks.